What's next for markets? Hello, I'm Stephen Gregory. I head the quantitative research effort at Piper Sandler. I'm filling in this week for Michael Kantorowicz. I'm joined here today by Emily Nadell, who is the Deputy Chief Investment Strategist at Piper Sandler. Hello, Emily. How are you doing today?
Hi, Stephen. Doing great. How about yourself?
I'm doing well, and we've got a lot to talk about today. The markets have been exciting to say the least.
That is for sure.
Yes. So tariffs, Liberation Day, huge drawdown in market. It was the, 28th since 1960?
Yep, Stephen, it's been the 28th, 10% or more drawdown since the mid 60s. And we have now fully recovered the losses year to date. This week on Tuesday, the S&P 500 climbed all the way back to flat on the year, which was an impressive move for sure. And we are getting a lot of questions as far as what to expect next.
I would agree with you that you had so much movement in the markets. You had this enormous drawdown and then sharp recovery in such a short amount of time, which is incredible in its own right. But a lot of investors seem to be wondering what's next. Where do we go from here? The market recovered, like you mentioned. The S&P 500 on Tuesday was back to pre-Liberation Day tariffs, even though we did begin to see some drawdowns. February 19th was actually the high watermark for equities.
February 19th was the peak this year. It was also the peak in COVID. I remember very well 2020. It was February 19th to March 23rd was the COVID drawdown. And this drawdown was just a little bit longer than that. February 19th was the peak, and then April 8th was the trough in the S&P 500 in 2025.
That's incredibly interesting. I did not know that fun fact. But not every equity, size, style, sectors performed the same. What was leadership like on the way down and then on the recovery?
Yeah, that's a great question. So if we were to look at it high level, the drawdown for size and style boxes, for example, we could start there. From that peak on February 19th through the lows in April, everything was down. Of course, you saw pretty widespread sell-offs, but the absolute worst size and style box on the drawdown was small cap value, which tends to be the most cyclically sensitive group with the lower quality names in it. The best size and style box on the drawdown was large value. And then I think what's interesting is that on the way up, you saw that small value also lagged, was not one of the best groups to recover. It was actually large growth that has seen the biggest improvement from those April 8th lows, actually up about 25% at this point from the lows. And so the size and style box has been interesting because we are now at a point where the S&P 500 is back to positive for the year and large growth is positive for the year. But most of the size and style boxes are actually still down. And the smaller indices, particularly small value, is still down quite a bit year to date at this point. Some other actually interesting observations from a sector perspective. So if you look at looking specifically at the drawdown, the worst sectors, the sectors that declined the most in that drawdown were tech, was down the most. Tech was down over 25%, discretionary and comm services. Those were the three worst performing sectors. In the drawdown, they were also the only three sectors that actually underperformed the S&P 500. And so what's interesting, I think, is that on the rebound, the move since April 8th, tech and discretionary have been some of the best sectors. So they have led the rise. But where we are now, when you look at the whole picture, year to date, tech and discretionary are still underperforming year to date. So they sold off really hard. They recovered more than everybody else, but overall net, they didn't recover as much as they underperformed on the way down. And so where we are now is still with those growthy sectors underperforming the market year to date. And the best sectors year to date are actually industrials, financials, the less growthy sectors, actually.
That's interesting. So on the way down and the way up, the best place to be was in flavors of larger caps. So the more defensive parts of the market, which is consistent with what kind of we've been talking about all year in the large over small. You have the economies of scale. You're better able to navigate this tariff situation. Because while we did get a pause in tariffs, there still are high tariffs around the world. And as Andy LaPerriere, our policy analyst, like point out, still at unprecedented levels of tariff rates. So what other kind of lessons could be learned from this move?
I would say one thing that's really interesting from my seat is that looking again at what we saw in the decline versus the rebound recently, we've seen, and people have been noticing that some of the riskier areas of the market, like high beta some of the other lower quality factors have bounced pretty sharply from the lows. But I think when you look more holistically at the entire move from the beginning of the year till now, you haven't seen such a strong bounce in beta compared to the sell-off that you've been seeing prior. So we have seen these areas, these super cyclical areas in the market really got squashed and they bounced, but they certainly aren't even close to where they were at the start of the year. And so there is still certainly an element of risk, even though investors are getting back into those risky trades a little bit. I think there's still a good amount of hesitation in terms of going fully into the risk on story. And I think that makes a lot of sense. I mean, where we are now, there are still a lot of risks out there. I mean, obviously, the worst case scenarios are now taken off the table. But as you said, we still have tariffs that are high, and we still have a lot of things that are potentially concerning for the future. So there's obviously enough optimism to get the large cap space back to positive on the year. But again, mid and small cap indices aren't as optimistic, aren't as positive. And some of the things to be concerned about at this point, obviously, earnings have declined a little bit throughout this whole tariffs scenario, but we are in what we call now the worry window. And this basically happens every time you get a sharp market sell-off. There tends to be a period where the market prices start to rebound, but earnings still continue to fall. And we think we're going to be in this period now for the foreseeable future where markets can stay kind of range bound or even climb a little bit higher, but earnings expectations are likely to continue to fall as we digest everything that's been happening. And so that is something that's going to be sort of an overhang in terms of sentiment moving forward, as we're going to start to see more of a decline in earnings expectations. And then beyond earnings, we still have inflation as a threat. We heard from Walmart this week that they're announcing higher prices from tariffs could come as soon as this month. And if Walmart's raising prices, I mean, that sort of sets the bar for everybody to be having to raise prices. And I think it may be certainly not as bad as we initially feared when we were talking about those crazy rates on tariffs in China, but still we are going to see some price hikes in various areas. And so that's obviously a risk for consumers as well. The April retail sales indicated that growth slowed quite a bit. In April, we had pulled forward a lot of demand before the tariffs came out, and the health of the consumer is something to be cognizant of. We have seen credit card delinquency rates have rose very sharply in the last couple months. We're basically back on the percentage of credit card debt that is 30 days delinquent is up now back to rates we haven't really seen since about 15 years or so. So we have seen it move sharply higher in those credit card delinquency rates. That's something that if we stay with rates being as high as they are, and rates actually, the 10-year yield got above 4.5% this week. So that is something that is concerning as well.
A lot of interesting things to unpack there. So there's still a lot of uncertainty in the system. And you were mentioning how risk bounced, but hasn't fully recovered. We're not technicians, but we've been doing this long enough to know it's never a great sign when you make a lower high. Also, you were talking about earnings. That was an interesting chart we were looking at this week. There are still tariffs. The earnings numbers haven't really moved that much. And all the moves we saw in this drawdown and recovery were all price, i.e. multiple. So where do we go from here and what are we going to see? Because there's going to be implications because of these big swings. What is the data going to look like going forward?
Yeah, that's a great question. And we are in what we call the worry window, which is the period where prices rise after a sharp sell-off, but you still see earnings estimates fall. And that's something that tends to put a lid on sentiment, because if we are going to continue to see earnings expectations falling, I mean, there's risk popping up in the news and in the system. And so we've seen at this point, the soft data, so the most leading of the economic data, has seen wild swings over the last couple months. We could look at the Michigan sentiment data, which has just cratered over the last couple months. It just came out on Friday and it declined again, which I think surprised a lot of people. And so we saw a big move in that data. We've seen big moves in terms of investor sentiment. If you can look at the bullish, bearish, the percentage of investors that identify as being bullish or bearish, and we saw the bulls, the percentages identified as being bullish really collapse very quickly after the tariff announcements. So that data is likely to rebound fairly quickly. Sentiment data has the tendency to move quickly. But the other data, the spending, the delinquency rates, demand, I mean, that stuff tends to take a little bit longer in terms of flowing through the system. And there is an entire framework in terms of looking at economic data. There's leading data that tends to move with the markets and leads the majority of the economic data. There's coincident data that lags the leading data. And then there's lagging data, which is the last of the economic data to turn. And so we are now in the point where we are still seeing some of the leading data falling. And so we have yet to see that flow through to the rest of the economy. And when we're in a situation like this, where the news happens so quickly, where we got terrible news and then much better news and things happen really fast, I mean, it's going to take a while for everything to sort of shake out and to see where things are going. But certainly it's unlikely that we're going to see a big reacceleration in growth from here. I think people are relieved that it's not going to be as bad as we had feared, but it's not as though, from what we talk about, from the people that we talk to, from what we look at, it's not as though we're expecting a big reacceleration in growth here. And so that has interesting implications as far as positioning from here, because as I had mentioned, we've seen the risk factors have recovered a bit, but not as much as they sold off. And I think it's going to be, in some ways, more of the same, in the sense that we're not likely to see a big reacceleration in risk equities, which has been what we've seen for the last couple of years. You could speak to it. I know we've talked a lot about the bifurcation in earnings that we've seen over the last couple of years. And even if we completely took tariffs off the table, we still weren't in a backdrop where we were expecting fantastic growth.
Absolutely. Longer term. And I think this is what's going to make the market really interesting is you have right now, we're in that window of worry where you're going to get a lot of conflicting signals between, say, the leading survey data versus the leading hard data, as it's often referred to, soft versus hard data. But then outside of the noise you're going to see right now, economically, once you brush that aside, you're still in a world where we just can't seem to get stimulus to really get that sharper reacceleration. So a sideways economy is essentially the average, but nothing is actually the average, which is how you have to think about it. So you have bifurcation. So you have winners and losers. And that has been the story of the last couple of years. And very simply, a lot of the winners have come down to those larger cap companies that have been able to continue to churn out stronger earnings, while small caps have struggled with higher rates, wage pressures. So once the dust clears, which could take a little time because of those things you were pointing out, you're left with a continued backdrop of earnings bifurcation, larger cap companies continuing to earn, growthier companies continuing to perform, and that scarcity to get bid up, which is just really a replay of pre-election. So that being said, Emily, back to you. What should people be watching?
Yeah, that's a great question. That is the big question here, because again, uncertainty has been the name of the game for the last couple months. And I think that certainly earnings estimates are going to be crucial here. And we know that they are likely to continue falling. We've seen modest declines in large cap earnings estimates so far, more significant deterioration in small cap estimates, which has been what we've seen for the last couple of years. We do think that with the tariff news, wherever tariffs settle, the fact that there are going to be higher tariffs than what we had previously should, in the near term, weigh on these earnings expectations. So that's something to watch. Inflation data, obviously, is still very crucial here. We got some softer than expected CPI data this week, which was comforting for investors. But at the same time, we also got this week an announcement from Walmart that we can expect higher prices from tariffs from them as early as this month. And if Walmart has to be raising prices to manage this situation, then basically everybody's going to be having to raise prices because Walmart is better able to negotiate prices for themselves. So certainly we are likely to expect higher prices in the coming months. And then on that same topic of inflation, consumer demand. And so obviously the higher prices go, the more of a risk we have to demand. April retail sales indicated that growth slowed quite a bit. And we, of course, we had that pull forward in demand prior because people were anticipating that there were going to be tariffs and price hikes and whatnot. But to see over the next couple of months what that demand looks like once we start to see these increases in prices and once tariffs have been in place will be really crucial. And then one other thing that I think is really important to watch is credit card delinquency rates. It's something we haven't been talking about quite a whole lot over the last couple of years, but the percentage of credit card debt that is delinquent has been on the rise. It's actually moved up pretty sharply over the last couple of months. And if we are now going to be in a backdrop where rates are high still, the 10-year yield got above 4.5% this week. That isn't particularly problematic for people that have these high debt outstanding. And so that is a potential weak link in the economy. So these are all things that we'll be watching to get a sense of what is the health of of the economy and how are we managing to maneuver through this period of tariffs. And then, of course, the headlines, everyone's following every single news headline that comes out of Washington, and that's certainly going to continue to drive moves in the market. One of our favorite charts, Stephen, we've been publishing a lot this year, has been the chart of the S&P 500 lined up with the trade uncertainty index from Bloomberg, and that's inverted. So as we've seen trade uncertainty spike higher, the market sold off, and then as that trade uncertainty has receded, the market has recovered. I mean, it's almost tick for tick. It's such an incredibly tight fit this year. And so certainly the hope is that we can continue to be in a backdrop where trade uncertainty is getting better and people feel like they have more of an insight as to what lies ahead, but it's a risk, right? I mean, we still don't know what's going to happen when the 90 days are up, and we still don't know what the next maneuver is going to be from the Trump administration. So that is something that, in our view, really is an overhang over the market and the risk trade, just because there is going to be an element of uncertainty for at least the next couple months.
So there's a lot of questions still to be answered. What is going to be the inflationary impact? How are tariffs going to settle? What's going to happen to earnings? Speaking to investors and all of the analysts here at Piper Sandler, the impact of tariffs is just almost an unanswerable question because the supply chain, pricing, and middlemen, and all these different things. Then you have the Fed in the mix, who's also in our shoes of watching the data. Any thoughts on what they're going to be watching and what are going to be some of the milestones for the Fed going forward? Seems like they're kind of torn between growth and inflation at the moment.
Yeah, they are certainly. I mean, I don't envy the situation that they're in this year. I mean, Powell repeatedly reminds people that his mandate is maximum employment and maximizing employment and inflation. And so that is what he is focusing on. And if we can see the inflation data stay relatively close-ish to 2%, I mean, that kind of, I think, opens the door for him to resume cutting again. I mean, the expectation right now in Bloomberg, if you look at WIRP, is for 2 cuts through the end of this year. That's something that the expectation is that that's going to get really started in September and then be more of a back half of the year story. So I think that if we can be in a backdrop where inflation is not spiking higher from the tariff situation, it talks about how how rates right now are restrictive. I mean, he says they're not extremely restrictive, but they are restrictive. And so I do think he has an inkling to want to lower them, but he needs to see that inflation is not going to become problematic, significantly off from what the target is. And so I think we had some good news this week in terms of the CPI data, and we'll have to see where things go. Again, inflation is one of the big questions from here. And that's something that everyone's watching for the next couple months to get a sense of how much is inflation going to be impacted. Now, a couple things that we have going for us in terms of what could keep a lid on inflation, one being oil prices have come down quite a bit. So that's obviously a positive for inflation not spiking up too sharply. And then also, we've been hearing a lot about how consumer demand got pulled forward, and there's now big inventory in terms of suppliers because they knew that these tariffs were coming. And so that also may help keep a lid on inflation over the next couple months because they were sort of prepared for this. So hopefully that combination of things will help us stay in a range where inflation doesn't get uncomfortably hot for the Fed to be really conflicted about whether or not they're going to be able to cut in this back half of the year.
So there are a lot of potential positives out there. We just need to work through this, what's the phrase we've been using? Economic
suppression.
Our call isn't for anything bad to happen. We just need to work through this data and get out of this kind of economic suppression.
I think that's fair. I mean, I think that our take and the way that we're thinking about positioning is to be balanced and be in high quality kind of names. I mean, we are not swinging for the fences saying go super risk on. We're not saying go super defensive. We're not talking about the economy crumbling into recession or anything, but we do think it's going to be choppy. I mean, there's likely to be significant bumps in the road as we move forward, and it's not likely to be a clear path. And so being in a balanced and high quality portfolio should help investors weather the volatility and sleep at night, because again, we've seen how big moves can be based off of headlines that are coming out of Washington that nobody can really predict. So the best thing you can do is sort of just hunker down and prepare for some bumpy volatility from here. But again, no, we don't think that this is a terrible outcome. We're not predicting that you want to be in defense or anything like that at this point.
So keep it tight. Don't go too far out on the risk spectrum. Remain balanced and high quality. Thank you so much, Emily. This is really great. So much to talk about. And this was very informative.
Great to be here. And we'll see what next week brings.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.